Welcome back to Noob Selling Options. Man, if you've been watching the charts lately, you know things are absolutely heating up. We are looking at a market that's rapidly approaching this historic 7,300 peak. But right underneath that peak, there's a massive 20% trapdoor just waiting to swing open. Now, if you're a passive index investor, yeah, that sounds terrifying. But for us, well, we're going to see how this looming market roadmap isn't just about surviving volatility. It's actually an option seller's absolute dream scenario. We are quite literally staring down one of the best premium collecting environments we have seen in years. So for today's explainer, we are breaking down a highly specific 2026 roadmap laid out by Tom Lee and Fundstrat. We're going to explore exactly why this push to 7,300 is happening right now, but honestly, more importantly, why the underlying mechanics of the market make a major aggressive reset not just possible, but highly, highly probable. Okay, let's dive right into this. Here is our agenda. 1. Tom Lee's 2026 roadmap. 2. Structural risks and valuation. 3. The macro stress events. 4. Evaluating the correction odds. And 5. The option seller's playbook. All right, Section 1, Tom Lee's 2026 roadmap. Let's look at exactly what Fundstrat is projecting for the S&P 500 this year. As of early May 2026, the S&P 500 has basically been hovering right in this really tight range, between 7,230 and 7,265. So what does this mean? It means the mathematical gap to that 7,300 peak is incredibly narrow. We are essentially knocking on the front door of the first major target right now, and it's being fueled by resilient corporate earnings and institutional cash that is just, kind of shrugging off recent geopolitical shocks. Now, the prediction breaks down into this wild three-stage sequence. Stage 1 is a near-term, final squeeze pushing us up to that 7,300 peak in Q2. But Stage 2, well, that's where things get wild. We're talking a sharp 15 to 20% drawdown hitting mid-year, pulling the index aggressively back down to the 6,000 to 6,100 range. And then finally, Stage 3 is a powerful V-shaped recovery in Q4, pushing the market to brand new all-time highs of 7,700 to close out the year. I mean, it is a total roller coaster. Moving on to Section 2, structural risks and valuations. So why exactly must the market drop 20% before going any higher? Well, a push to 7,300 isn't just coming from pure earnings growth, right? It requires significant multiple expansion, which makes the S&P 500 historically stretched. Think about the Peter Lynch peg ratio for a second. That's where you compare a stock's price to earnings against its actual earnings growth rate. The disconnect right now is glaring. To justify these current prices, forward earnings growth has to be absolutely exceptional. Let's say a mega-cap tech stock is trading at a sky-high PE of 35, but its earnings growth cools down to, say, just 15%. That PEG ratio shoots way past the comfortable 1.0 to 1.5 range into totally overpriced territory. When that happens, a 15 to 20% correction isn't actually a panic. It's simply the market mechanically resetting those ratios back down to historical averages. And compounding this whole evaluation issue is the structural makeup of the index itself. The mathematical reality here is that the S&P 500 is just unprecedentedly top-heavy right now. It is deeply tethered to just a handful of U.S. mega-cap technology and semiconductor companies. You know the ones: Microsoft, NVIDIA, Broadcom, Amazon. And while that concentration pulls the overall market up super fast, it also creates massive structural fragility. If institutions decide to take profits on these high-conviction names, their sheer market cap weight basically drags everything else down with them. Because these tech giants are high beta, a 15% drop in the broader S&P 500 often translates into a brutal 20 to 25% drawdown in those underlying tech leaders. And here is where options mechanics kind of pour gasoline on the fire. When markets grind higher for prolonged periods like we've seen, implied volatility, the VIX, gets heavily suppressed. Institutional hedging decreases, and options positioning gets super skewed to the upside. But when a negative catalyst hits in this low volatility environment, options dealers can get caught in a state called short gamma. Basically, to remain market neutral as the market drops, these dealers are forced to aggressively sell underlying shares right into the falling market. This unwinding accelerates the sell-off exponentially. It turns a totally standard dip into a violent 20% crash. All right, Section 3, the macro stress events. We know the plumbing is fragile, but what's the actual pin that pops the balloon? What triggers the drop? This 7,300 peak basically prices in this perfect Goldilocks scenario. But reality is colliding with that perfection right now. The biggest immediate variable we're tracking is the May 15th transition of the Federal Reserve to incoming chair Kevin Warsh. Now, impartially speaking, Warsh has a very hawkish reputation regarding federal spending. So when you combine a new Fed chair who might tolerate some economic pain to crush inflation with a difficult macro backdrop, specifically we're looking at sticky 3.3% CPI and crude oil spiking up near $115 a barrel because of the ongoing Hormuz blockade, the narrative changes really fast. In fact, macroeconomic models like the Taylor rule, which links interest rates directly to inflation and economic growth, suggest the Fed should actually be hiking rates right now, not cutting them. And that seriously threatens the discounted cash flow valuations of all those growth stocks we just talked about. Then you got to add seasonality to the mix. 2026 is a U.S. midterm election year. Historically, midterm years are the most volatile of the four-year presidential cycle. Markets hate political uncertainty. As campaign rhetoric heats up, capital just naturally tends to move to the sidelines. This aligns absolutely perfectly with the classic sell in May narrative. Deep summer drawdowns, often in that exact 15 to 20% range, are incredibly common in midterm years, usually bottoming out around late Q3 before all the political gridlock finally gets priced in. Which brings us to Section 4, evaluating the correction odds. We have the roadmap. We have the triggers. But what are the actual probabilities of this sequence playing out? Well, looking at the data, the odds of hitting that 7,300 peak are considered very high. The gap is narrow, and corporate profitability still has some serious momentum behind it. However, the odds of a 15 to 20% correction immediately following it, those are moderate to high. Market history heavily favors a pullback after sustained momentum, especially when you have the midterm seasonality and a major Fed transition acting as your primary catalysts. So what is the ultimate signal we need to be watching for? It's the relationship between the broader S&P 500 and semiconductor leadership, the SOX to SPX ratio. If the broader market keeps pushing higher into that 7,300 zone, but semiconductor stocks start stalling out and they stop leading the charge, that is your massive flashing red light. It signals that the move isn't a fresh structural breakout. Actually, it's just a final exhausted squeeze. Finally, Section 5, the options seller's playbook. It is time to completely shift this narrative from market fear to massive tactical opportunity. So, how do we actually turn a 20% market panic into an options seller's premium collection machine? Remember, for us, a rapid drop down to the low 6,000s is absolutely not an apocalypse. It is a necessary reset that clears out the weak hands. It's really just the market plumbing doing its job. And for a prepared options seller, it is our ultimate setup. Okay, here is the tactical playbook. Step 1, we patiently wait for that rapid 15 to 20% unwinding. Why? Because a sudden drop causes a massive instantaneous spike in implied volatility, or the VIX. Step 2, when panic is at its absolute peak, we target fundamentally sound mega-cap tech stops. We're looking for the ones with true, undeniable moats that are just getting unfairly punished by the broader market beta drop. Step 3, we initiate the wheel strategy. By selling cash-secured puts and later covered calls if we get assigned, the spiking premiums during a panic sell-off mean the math shifts entirely into our favor. We can collect outsized, super lucrative premiums at strike prices that seemed impossibly safe and far away just a few weeks prior. If you found this explainer valuable and you want to be fully prepared to collect those massive premiums when the trapdoor finally opens, please make sure to hit that like button and subscribe to Noob Selling Options. We are going to be tracking this roadmap every single step of the way. And I want to leave you with this final provocative thought. Market resets aren't something to fear. They are simply wealth transfer mechanisms, moving capital away from panicked indexers directly into the hands of prepared option sellers. So, which side of the trade will you be on? Thanks for watching, and I'll catch you in the next explainer.